Hi everyone, this is a technical analysis on Aussie dollar. Let's start with some fundamental background first. In the US, the Fed left interest rates unchanged as expected at the last meeting, with basically no change to the statement. Fed Chair Powell stressed once again that they are proceeding carefully, as the full effects of policy tightening have yet to be felt. The US core PCE yesterday came in line with forecasts, with the disinflationary progress continuing steady. The labor market is starting to show weakness as continuing claims are now rising at a fast pace, and the recent NFP report missed across the board. The latest US PMIs came basically in line with expectations, with a miss in the manufacturing index and a bit in the services measure. The US consumer confidence this week beat expectations, although the details about the labor market continued to weaken. The hawkish Fed members recently shifted their stance to a more neutral position. The market doesn't expect the Fed to hike anymore. In Australia, the RBA raised the cash rate by 25 bps as expected at the last meeting, as the central bank judged that the move was warranted to be more assured that inflation would return to target in a reasonable timeframe. The recent monthly CPI report missed expectations across the board, which is a welcome development for the RBA. The RBA Governor Bullock has been leaning on a more hawkish side recently, although she remains optimistic on the future outlook. The labor market continues to weaken, as seen also recently with the bulk of jobs added being part time. The wage price index surprised to the upside recently, as wage growth in Australia remains strong. The recent Australian PMIs fell further into contraction for both the manufacturing and the services sector. The market expects the RBA to hold rates steady at the next meeting. Now on the daily chart, we can see that Aussie dollar rejected perfectly the trend line here around the 0.6675 level, where we had also the 61.8% Fibonacci retracement level for confluence. The sellers piled in with a defined risk above the trend line to position for a drop into new lows, with the first target being the support zone around the 0.65 handle. On the 4-hour chart, we can see that the price has been diverging with the MACD into the key trend line. This is generally a sign of weakening momentum, often followed by pullbacks or reversals. In this case, it was another bearish confluence for the sellers, which was further supported by the rising wedge formation here, which is considered as a reversal pattern. The breakout of the wedge might be another confirmation for the sellers that we will likely see at least a deeper pullback into the 0.65 handle. The buyers, on the other hand, will likely lean on this support to position for a rally with a better risk to reward setup and target the break above this major trend line. On the 1 hour chart, we can see that the price yesterday pulled back from the seller following the breakup of the wedge. The sellers land on this downward minor trend line as they keep targeting the support around the 0.65 handle. A break below this current minor support around the 0.66 handle is likely to trigger another wave of selling as the sellers will increase their bearish bets into the support. The buyers, on the other hand, will want to see the price breaking higher to invalidate the bearish setup and target a break above the major trend line. Today, the main event will be the release of the US ISM manufacturing PMI, which missed expectations by a big margin the last time. A strong report is likely to give another boost to the US dollar, while weak figures could weigh on the greenback in the short term.